We're going to start off with a quick summary. This is the DUI, Days Unsold Inventory, how quick the market is turning over compared to the 10-year median. You can see that the vast majority of Silicon Valley is blue in color, which means it's slower than normal. These are the percentages. They're all above 100% that I'm seeing. And when a large number means a longer time to turn the marketplace over. So for example, in Santa Clara County, it's taking 17% longer. Silicon Valley overall is 26% longer. San Mateo is 36% longer, and Alameda County is 33% longer. So it's taking quite a bit longer than normal. And then just compare it to last week. This is the same information from last week. And you can see Silicon Valley was 23% over, then each of the counties on there. And then just for reference, at the end of the year, December 28th, we had quite a bit of red and a lot of white still on the map. That's how much the market has changed. So let's get into the normal presentation. These are the chapters that we're going to be going over. You can jump to the chapter that you find most interesting using the links in the YouTube description below. The handout is published. Let's get into the data. Here's a summary slide. This is the first one is inventory. You're looking at the gray line being the typical marketplace. Typical marketplace is defined as the 10-year median. The blue is the most inventory you'd expect for that period of time. And then the red is the least inventory you'd expect. The last data point here in the middle, the purple, which is the current data, is this week's data. Then you go back a quarter, and I go forward a quarter, and obviously I don't have actual data going forward a quarter, but that's to show you the trend. Inventory has been growing like it normally does at this time of the year, but it's been growing more rapidly than normal because you've pulled away from the gray line, and now you're approaching the blue line. So we've had an increase in inventory. In fact, you can see it in a percentage basis. We went from 85% of the level of inventory you'd expect back here 13 weeks ago to now the current week, not 13 weeks in the future, but the current week, we have 20% more inventory. So we've had a swing of 35% of the inventory you'd expect to have. Moving down to offers, the concept is exactly the same. In this case, limited offers favors the buyer, which is why it's blue in color. And you're about halfway between the typical what you'd expect and the number of offers. You can see that we're at 90% of the level of offers you'd expect. 13 weeks in the past, we were at 80% of the offers. So offers have come up only 10%. At the same time, inventory has come up 35%. So clearly a lack of buyers at this point in time. The days on unsold inventory, the most interesting part. Here you can see we were sort of matching the slowest marketplace. Look at this last week. We've gone up, we've increased, which is a slowing down of the marketplace at a time when the market is normally accelerating. So we're now at that 126% of normal, and 13 weeks in the past, we were right at normal. So we were at normal, then we got slower than normal, and now we're even slower than normal. Moving on to days on marketplace, keep in mind at this time of the year, all the inventory is fairly fresh on the marketplace because you carry very little over past the end of the year holidays. Therefore, you have very low days on marketplace. We're sitting at 15 days, and that is actually 20% faster. It's only 80% of what you'd expect. It's 20% faster than the typical line. Now, you can see just earlier this year, we were quite a bit faster than the fast line. So we are slowing down a little bit, but we're still nothing to be concerned about as far as the speed of the market for those that are successful in selling the properties. The real question is, what about those that aren't successful in selling their properties? And we really don't track that, unfortunately. Looking at ask price reductions of those that successfully sell their property, notice you've gone from just above the gray line, the typical line, to now below. So you're taking more frequent price reductions. In fact, right now we're taking 69% more price reductions than we would expect. Over here, it was, at the beginning of the year or 13 weeks ago, when, it looked like it was typically normal, it was 6% more. And so these are the magnitude of the price reductions. Now, keep in mind, it's still a very small number. Back here a quarter ago was only a 1% price reduction, which a lot of people would say is nothing, but it's the fact that 15 or 20% of the marketplace is taking fairly significant price reductions. 80% of the sellers are able to sell without doing any price reductions. Now, when it's almost 70% more larger price reductions than normal, it's only half of 1%. So at this time of the year, there's basically no price reductions going on. So even a small price reduction ends up quite a bit more than normal. And that's why it's important not to just look at the magnitude of the number, but also to look at where that is relative to what you'd expect it to be. And then overbids is on here more as a curiosity, because it really doesn't tell you what's happening now or what's likely to happen in the future. This is looking back in the rearview mirror, because this is transactions that are closing, and the typical transaction is taking 4 to 6 weeks to close. So that the terms of the offer were negotiated back when the offer was accepted, not when it closes. So you went from 3% or 8% overbidding typical. We were getting 5.3%. So if I'm doing my math right, that's 1.5% more overbids bidding in percentage of value of the property. So the sellers were getting 1.5% more than they thought they were getting, or than they were asking compared to normal. Now you're at 8.9 versus 5. So you're getting a full 3% more. So the overbidding is still very aggressive and would suggest the market's on fire. And I'm not sure that's the case. And this is sort of the key components. Inventory, the purple line. Look at this. At the end of the year, we were basically at 73% of typical, and now you're at 120% of typical. So your inventory has gone up almost 50% of the normal level of inventory. That's huge. For those that want to look at offers, it's gone from 69% up to 90%. So you gained 20%. Clearly not as much as the inventory has gone up. And this puts a huge dent in anyone that wanted to argue we were in an inventory limited marketplace. If we were, the number of offers would have kept up with the growing inventory, and that's simply not the case. But now more important is the ratio between the days unsold inventory. You went from basically some number right around 92, 93% of the turnover rate that you would expect to now at 126% of the turnover rate of the inventory that you'd expect. So the market has slowed down fairly significantly, 26% plus about 7%, that's about 33%. So the market has slowed down by a third. So it's a third slower now than it was just at the end of the year. Now looking at each component individually, here's your inventory. Look at the rate of growth of that inventory. I mean, at the end of the year, you were red hot marketplace, quickly came up to the typical what you'd expect. And then it's basically been these last couple of weeks where you left the gray line and you shot up and you're reaching and almost touching, but not quite the blue, the most inventory you'd expect. So clearly inventory is growing, and it's growing fairly rapidly. Here's pulling that gray line out, making it 100%. You can see from a percentage basis, you went from something like 77% of the inventory you'd expect to now 120%. So again, you've gained close to that 50% of the inventory you'd expect. So if you were at 75%, you're now at 50% of the now at 125%. So it's not quite 50%, maybe it's closer to 45%. But again, a huge gain. The other thing I'll point out is look back in time. You rarely have had 20% more inventory than you'd expect. We did have that at the end of 2018 and into early 2019, which was a slowdown for Silicon Valley. And then, you barely were over it here early in 16 and a little bit in 15, but we almost, 20% may not sound a lot, but when you look at it on a historical basis, it's rare for Silicon Valley to have 20% more market inventory than it typically does for that time of the year. It is definitely noteworthy. Now looking at the number of offers accepted, you can see that the offers looks like it was pretty much keeping up. In fact, it did, was on the blue line, so less offers than you'd expect, sort of caught up to the gray line, and now it seems to be falling behind the gray line. So we're now not improving the offers even as much as you'd expect. So even though inventory is growing more rapidly than you expect, offers are not growing as much as you would expect. So there's an ever increasing gap between the offers that are being accepted and the inventory, which is, in my opinion, clearly an indication of a slowing marketplace. Here you can see that the offers were apparently keeping up, and then they've turned around and they've gone down this last week. So you went from basically 92% of where you should have been to 90% of where you should have been. And that's why I do it both ways, is sometimes the first chart, which is like this, where you're just looking at the raw numbers, it looks like the lines are getting farther apart and they're actually not. It's just optical illusions. It's really hard to tell the vertical separation, which is what we're really talking about. So this is your days of unsold inventory, the speed of the marketplace. Look at this sharp bend last week. We left the blue line, so the market was slower than you'd expect already, and now you're above. And if you look at the vertical separation, you're starting to see that we're quite a bit slower now than you would expect, or even in the slowest marketplace, you'd expect the number to be down somewhere around here, which is, rough numbers going horizontally over is maybe 35 days. And up here, you might be at 38 days. So you're 3 days longer to turn over your marketplace. That may not sound like a lot, but again, how often is the purple line above the blue line? You go back on this chart and it's not very often. And now you have that territory where the purple line, the data line, is above the blue line. Here's on a percentage basis. And here it's easier to see, there's been a little bit of time right here in 2022, little spikes, but not even the whole slowdown where you had a slower marketplace. And during the pandemic shutdown, you had a slower marketplace. And again, in the latter half of 2018, you had a slower marketplace. But I mean, those are short-lived. And if this keeps the trend, this is where we were just at the end of the year. So not even 3 months ago, what would that be? Something like 10 weeks ago, we were fat, happy, and everything else, and below a hotter turnover rate. And now you're quite a bit slower and not quite in record territories by any stretch of the imagination, but getting up into sort of rare territory. Here's your marketing time. Now, this is for those that want to be optimistic about the marketplace. You're down here and you're selling out 75% of your inventory in 15 days. How could that be a slow marketplace? Well, it can be, because normally you're down here at 13 days. And you have a little bit of step function here where you really don't know if this is at 15 days, almost at 16 days, because of the refinement. But also noteworthy, in my opinion, is notice that we're turned up already. In other words, we're having a longer days on marketplace, a slower marketing time rate. And typically, at least according to here, well, typical's up to here on the gray line, so let's go there. It doesn't happen until halfway through second quarter. So you're clearly having this happen roughly 8 weeks, 2 months earlier than it normally slows down, because we've already had a slowdown. We've already done a step up, and next week, who knows? There's no way to know, but my suspicion is it will step up again. Here is the turnaround. You can see right here is sort of the bottom of the marketplace halfway through this first quarter. Now we're getting towards the end of the first quarter. And yes, it's still faster than typical, but look at the slope at which that's climbing. If you just predict that going up, and, if you look back, this is a smoother slide, smoother data than a lot of mine. You have these rapid improvements of the marketplace as we come in with new inventory, and then boom, you turn around and go back up. Now, keep in mind, we're comparing this to normal, so that if we were having a normal year, it would be horizontal. We already are taking into consideration the typical number of new inventory coming on the marketplace. Here's the seller's ask price reductions. So this is the sellers that have come on the marketplace, mostly since the first of the year, since you have very little inventory carryover. They had certain expectations and they set their list price accordingly. And, the gray line again is where they would expect the number of the magnitude of price reductions to be. So you'd expect it to be up here somewhere around 92%, 93%. And in fact, it's down here somewhere around 91%. So sellers are taking 2% larger price reductions. And again, that may not sound like a big number, but this is the sellers that are taking the largest price reductions. It's the 10% of the sellers that are taking the largest price reductions. Here it is in terms of normal. So this is where you'd expect to be. You can see we spent most of last year taking price reductions. You can see how people got their expectations were in line with reality, or reality and expectations were in line. And now again, they're out of kilter already. And I think what this is simply at the very beginning part of the year, you don't have time to do a price reductions. If you put your property on the market on January 10th, for example, you're not going to reduce your price most likely until February 1st at the earliest. So it takes time for that to happen. But again, it's compared to normal. So that rundown was more buyers' expectations that the market was going to improve versus the market actually improving potentially. Here's the average. So you can see that I wasn't playing games by looking at the largest 10%. Typically at this time of the year, sellers are taking about 0.3, maybe a third of a percent price reductions. Now they're over 0.5% price reduction. And again, that change of 1/6 may not sound like a lot, but keep in mind that the vast majority of the sellers do no price adjustments whatsoever. Here's compared to typical. So you can see now that you're down here in the blue territory and the cool territory, and you're falling rapidly. You've been falling rapidly since fairly early, probably 5-6 weeks into the first quarter. The purple line has been going down. Yes, you started up in the red territory, but you went right through that gray normal marketplace right here on the x-axis. Here's the frequency of price reductions. So how common are price reductions? You can see they were less price reductions than normal. And also, this was the first slope that I showed. It slipped 1 week horizontally, which I don't understand why. And I don't understand why the DOM has shifted several weeks earlier in the pattern. But now you cross back over and you're now between a typical marketplace and a cool marketplace. So it looks like we're already going up this slope here that typically doesn't happen until the beginning of second quarter. Here it is with the gray line pulled out. You can see that we heated up and now we're slowed down and we're again above the gray line. Here's the overbidding. So this is what the buyers are sensing. So even though inventory is growing and offers are falling, basically, which is I think what I've been saying, now the buyers are still saying we're in a competitive marketplace and we're overbidding, and they're overbidding more than you'd expect. So this is sort of contradictory. Part of it is the 5-week lag, but we've been in this bad news situation for more than 5 weeks. So buyers are still sensing the pressure out there, even though the fundamentals of the marketplace appear to have changed. Here you can see now this last week, the buyers cooled off a little bit, and keep in mind that this is going back 5 weeks, but still a more rosy picture than I would expect. The buyers are overbidding more than I would expect based on the market fundamentals. Here's the frequency of overbidding. So how common is overbidding? And you can see buyers are overbidding more frequently. So that may be what's pulling up the magnitude, is if everybody's overbidding a little bit, there's nobody pulling it down, but you're basically something like 75% of the buyers are overbidding on the offers they're making that they made 5 weeks ago, because you don't know if they overbid or not until escrow closes. Again, it's been higher than normal now, basically since most of 2024 and all of 2025, basically from right about halfway through third quarter of 2023, with a few minor exceptions. The amount of overbidding frequency has been higher than you'd expect it to be for a typical marketplace. Here's the frequency. Yes, it's come down this last week, but it's still up here in pretty red territory. It's been higher than it's been for the last 18 months, basically since midpoint of 2023. So that's a little bit more than 18 months. So you've had 7 quarters of more frequent overbidding for the most part than you'd expect. Here's pricing, which is also looking pretty good. We're not back up to our record pricing, but Silicon Valley is back up to 1.7. We're rapidly approaching the peak pricing of last year of 1750, and that's roughly equal to the peak pricing we had way back here in 2022 of about 1750. I don't know what those exact numbers are, and we're still a little shy of 1700. So that's 1.7 million, and that's on log paper. And here is the monthly payments. And this assumes doing a national average high balance conforming, which inflates the payments, but it gives you a relative number. And the concept here is payments have been basically flat on the high end, basically flat on the median, and actually a little bit lower, I would say, on the lowest, cheapest priced homes. Basically, if you believe payment-driven market, this is more important. So in other words, if buyers buy based on their monthly payment, this is more important. And that's true more in the 10 and 50% price range. Up here in the 90% price range, people aren't getting an 80% loan and usually have other investments that they're putting into their purchase. Here we're now looking at distributions. The purple line is the current week. We are going to start off a year ago on the dotted line, March 15th of 2024. You can see the dotted line is basically on top of or a little bit below the purple line, but they're very close together. That basically says this year is slightly cooler than last year, not significantly. The purpose of this is, one, to show you the distribution. You can see that 10% of the sellers are taking something like 30 days to sell their property. But, the 75th percentile that I look at is down here at 15 days, might have been 14 days a year ago. But, you get down here and 50% of the sellers are selling their properties basically, essentially, as soon as they will accept the offer, which is why I don't use the median or the average. This is clumps together. You come up here and you get some spread. So anyway, as we step through, you'll see that the data goes down, turns around, comes back up, bounces a little bit. And this is sort of now it's slowing down for the summer. And here's coming up to the summer plateau where it just bounces for several weeks. And then basically somewhere right after Halloween, it will start slowing down. And at the end of the year is sort of the bottom of the marketplace. And then the beginning part of the year, it accelerates rapidly. And there you can again see the purple line is on top a little bit higher than the dotted line, which is barely noticeable underneath. You can see the round dot circles there. So that's the days on market marketing time. And this now is doing the same concept with the sellers taking the largest price reductions. Here we're looking at a weird number. We're throwing out 2.5% of the sellers that are taking the largest price reductions because that includes data errors. That includes just bizarre stuff. And then we're going down to 17.5%. So we're looking at a 15% segment of the marketplace decreased off the largest by 2.5%. You can see that the price reductions this year are on the blue side, which means we're taking larger price reductions. The red line up here is our record high and also the basically no price reductions whatsoever. And that was basically Valentine's Day of 2022, just before the market started to collapse on us there. You can see that we're quite a bit cooler here right at the 7.5% point. We'll step through. You can see the market should go up for a while and then it cools down. And now you're sort of in the summer doldrums where it really doesn't change too much. Some bouncing. And again, this is going to move right around Halloween time frame. Right there, big downturn. And I think that was about November 15th or something. And then we're beginning part of the year, and we're back up to the current data point. Here's now looking at overbidding. This is buyers' competitiveness. This is how much buyers feel they need to be aggressive in their offers. So the purple line again is a little bit hotter than the dotted line a year ago line. So that means buyers are actually feeling more pressure this year than they did last year. And it's those buyers that are overbidding the most up here that are appearing to make the difference. You come down here, even 25%. So the top 25% of the buyers are overbidding significantly more. This bottom 75% of the buyers are pretty much on top of last year's line. They're still a little bit more aggressive this year than they were last year, but 75% of the buyers are essentially doing what they typically do. It's this top 25% that are more vertically separated from the dotted line a year ago. But again, the concept is, what do we expect the market to do? Well, follow the dotted line. You expect the dotted line to climb. So you'd expect the overbidding to start to still continue to increase for several weeks before it reverses. And here everything is delayed. So now it's the false doldrums. And instead of turning it at the Halloween, which is right here, it doesn't turn until about Thanksgiving, right about now. And there you can see the walk down at the end of the year. And then the beginning part of the year, the walk up. And that's what we're in right now. But pay attention. There wasn't much walk up between last week and this week. So we may be already to the point where overbidding will start coming down and not hit the peaks up here that we did just last year. There's no way to know what that data is going to be. And the strong indication would be that it will go up, and we'll know next week. Here now is looking at the three counties. You have San Mateo County in the orange, you have Santa Clara County in the blue, and Alameda County in the gray. Inventory in all three cases is climbing, and is climbing fairly steeply. It typically does, and that's why I like to plot things compared to typical. I don't do that on these series because we've already gone over that. Here's your offers climbing in all three areas. But if you look at Alameda County here, look at how it leveled off from last week. So it's basically the same levels in Alameda County as the week before. It even looks like San Mateo, it hasn't leveled off yet, but to me, it looks like we're starting to crown over at the peak of the mountain. You tend to crown over. See how you, like here, you round it off? This to me looks like the rounding off part. So I'd expect maybe San Mateo County to be flat next week. Clara County is less of an increase, but not to the point where I'd call it rounding over yet. Here's days unsold inventory. So the turnover rate, you can see Santa Clara County, all three of them basically have been bouncing a little bit, but Santa Clara County is pretty much flat. I would call San Mateo County flat. Alameda County is still downward, which is an improving. The lower the number, the faster the turnover rate. So Alameda County is still in downward trend. This may have been an upward trend this last week. The squiggles are sort of amazingly similar across all three counties, and that's probably more due to calendar events, holidays, and those kinds of things than shifts in the marketplace. But basically, it appears that all three counties are ready to slow down a little bit. Here's marketing time, and this is the time for the sellers to actually accept their offer, 75%. You can see it's basically going up in all three regions. San Mateo County might be the exception in the orange. It's down this last week, but it's still up from its valley. So all three have come up from where the low of the year. They're all still very fast. All three are below 18 days to sell 3/4 of their offers, and that's pretty quick. Here's the price reductions. These are the price reductions the seller is taking to get the offer accepted. Notice it's increasing in all three counties, especially Santa Clara and San Mateo County. Alameda County, you could clearly argue, is flat. But again, these numbers are fairly small because they're the average. It's about 0.75% reduction for San Mateo County and Alameda County. Santa Clara County is up here at about 0.3% of price reduction, about a third of 1%. Not very much at all, but it's more the trend. You can see these numbers are very tight, and again, that's because most of the sellers price their home to the point where it's going to sell at or above their asking price, and they not need to take a price reduction. How common is price reductions? Santa Clara County, only 6.5% of the sellers have done a price reduction. In San Mateo County, it's at 9%. In Alameda County, it's only 10. So only 1 in 10 sellers have done a price reduction in Alameda County, and that's the most. The magnitude of overbidding, you can see that Alameda County and Santa Clara County are neck and neck here at about 9% overbidding, which is pretty aggressive. San Mateo County is down here at about 7.75% overbid, and that's above the seller's ask price. This is the frequency of overbidding. We range from 71% to about 77%. San Mateo County having the least overbidding, Santa Clara County having the most overbidding. Here's the long-term appreciation. Santa Clara County is by far the best appreciation at 120%. This would actually suggest that Santa Clara County by itself is now higher median price than it ever has been because it's the highest percent appreciation. It looks like it's outdoing the 2024 appreciation. San Mateo County and Alameda County are both down around 85% appreciation, and they're clearly below their previous peak. Santa Clara County has been doing the best, it appears, in my opinion, since the pandemic, and very clearly the best since about 2023. Here's your pricing. San Mateo County went up significantly this last week and is now again above Santa Clara County in the blue. It's hard to see Santa Clara County in the blue, but it's about right even with the blue line and my red dot. You can sort of see it on the right-hand side of the orange line peeking out there. And I do take away the orange line offline to make sure that's the peak of the marketplace. And here you can see Alameda County, it's still below their peaks. Here you can see the blue line is above their peak of 2024. And so Santa Clara County is just setting a record high median sold price. Here's the same information. You can see the blue line a little bit better in this graph. And this is on regular paper versus log paper, the previous slide. And you can see that Santa Clara County is just above its record median price. Here's the estimated payments. They're going to be in the same order because this goes through just a math formula based on interest rate, property tax estimate, and insurance estimate. Here now is the heat maps. This is showing inventory. So across the board, you have more inventory. Basically, everything's blue except right through here, Campbell, Santa Clara, Willow Glen, Cambrian, which is white in color. And when you look at that, it's at 90%. So it's actually a little bit less. Atherton's at 94%. Everybody else is at 100% or above. And most of them are about 112% or above. This is number of offers. Across the board, you're starting to see some shades of blue. The lowest number I am picking up quickly is actually Morgan Hill Gilroy at 72%. So they're doing the least well. And I'm not, Los Altos and Palo Alto's at 2% above the level of offers, but most everybody's below. Silicon Valley overall is at 90%. Santa Clara is at that same 90%. San Mateo County is at 95%, and Alameda County is at 87%. So I group them by county. So I put the horizontal line, so Alameda County is all together. So Alameda County has 87% of the offers you'd expect. Here is sort of the telling one. This is what I did my summary slide on. This is the speed of the market compared to where you expect it to be. Look at how much blue there is. Santa Clara County is the only one that's doing somewhat well, and those numbers are even around 110%. So 10% slower is white in color. I go white in color till about 12.5% slower. But look at the overall Santa Clara County, 17% slower than normal. San Mateo County, 36% slower than normal, and Alameda County, 33% slower than normal. And that's measured as the turnover rate of the marketplace. How quickly would you sell out all your existing inventory at the existing rate of sales? Here's the days unsold inventory. So this is in sharp contrast for the previous slide, because now it's all red and you go, it's the same information. No, it's not. The market is normally on fire in Silicon Valley. So you can still have fast turnover rates of basically 30 days a month in Santa Clara County, 38 days overall, and that be quite a bit slower than it typically is. Normally at this time of the year, the market's just flying off the shelf at a little bit slower pace. So that's the importance of the understanding the data. So the market's still turning over. Sellers, you'd sell the existing inventory in 30 days, but on this previous chart, that's actually 17% slower than it typically is. So normally it's taking 25 days. Will you notice the difference between 25 and 30 days? Maybe not, but it's the fact that the market's quite a bit slower than it should be that's the alarming part. Here's the marketing time measured on days for the 75% of the sellers to sell. You can see Silicon Valley is at 15 days, still very fast. So Santa Clara County at 13, San Mateo County at 15, and Alameda County at 18 days. So clearly Alameda County is the slowest. Clearly Santa Clara County is the fastest. Here's the price adjustments. This is the average. So you can see very small numbers. Most of them are below 1%. Yes, you have some that are 1% or greater. East San Jose, Central San Jose, the affordable areas. The big notable exception is the San Mateo County coast at a 3% price reduction. Foster City and Redwood City at 1.2%, and nothing, Oakland at 1.1%. So the amount on average that the sellers are reducing their prices are still pretty small. Here's the frequency of price reductions. Very few sellers are adjusting their price, which is why it's red in color. So you're clearly getting some fundamental mixed signals, but to me, the rate of growth of inventory and the drop off in the offers is the key. And that ties into the days of unsold inventory compared to the 10-year median being slower than normal is where it is. And overbidding magnitude, this is how much buyers are overbidding. You can see in Silicon Valley, it's 9%, 9% in Santa Clara County, 8% in San Mateo, and 9% in Alameda County. So pretty much right at 9% overbid, and that's the average overbid. That's why it's higher. The other number that's down around 5% is the median overbid. Here's the frequency of overbidding. You can see that overall, Silicon Valley, 3/4 of the sellers are getting more than their asking price. It jumps up to 77% in Santa Clara County, down to 71% in San Mateo County, and 74%. So just between 70 and 75% of the sellers are getting more than they're asking. So it's hard to say the market's slow, but again, it's the fundamentals of the marketplace that have me very concerned. Appreciation, very slow in San Mateo County, areas that used to be close to work centers. Santa Clara County is very much red in color. The few exceptions are the expensive areas on the northwest side of the valley. They're more like San Mateo County. And then you get into Alameda County and it's mixed. It's, sort of the Tri-Cities areas that's on fire. Everybody else is sort of blue. So that's where you have on appreciation. This is now the sold price. The middle number is the median number for each of the micro market areas. The number to the left is the cheapest 10%. The number to the right is the most expensive 90% pricing. So in any area now, you know the price range. So for example, if you're looking in Santa Clara County, you'd expect for single family homes, you'd expect to pay between 1.2 million on the low end, all the way up to 4.1 million on the high end. And the median priced home is basically rapidly approaching $2.1 million. Here's a summary of the information we went over. You can start on the left-hand side in the micro market area, see the micro market conditions across the board, or start over here with the payment or the purchase price, and again, see the conditions as you come back to the left. And again, my big concern is look how blue this column here is. This is the days on sold inventory, so the turnover rate on the marketplace compared to the 10-year median. So even though the turnover rate is red, and I'm not denying that, it's much slower than it typically is. You have much more inventory than you typically do, and you have fewer offers than you typically do. And it's the fundamentals here on the left-hand side of the chart that have me concerned. I could make these blue easily by just changing where I do the color. Now, clearly I could also change these to red, but these have been my long-term metrics, and I'm not going to mess with colors just to mess with colors. But it's the fundamentals here on the left that I think are going to weigh on the marketplace. Here are the actual raw numbers if you want to look up for any of the 3 counties or Silicon Valley overall. You can see the number of new listings is down this week, which is a positive sign. You can see the active inventory is still up. You can see offers are up. Inventory is up more than offers are up, which is not a good sign. You can see days unsold inventory is increasing. Not a huge amount, only 1 day. My alarm bell is about 5 days per week, so we're nowhere near that. And you can look at whatever metric you find most interesting and get the actual raw numbers. Here again is my overall concern. I will disclose that the last 2 lines here are not second place. You can see that over here. They're 23 out of 25. The reason I went ahead and made them second worst is they're within 40 offers of being the lowest. And as you know, this is a live database, and escrows fail. I fully expect more than 40 of these transactions to fall before they all close, and therefore they will become record lows. Everything else is currently accurate. We're getting close here. We're only off by 8. This may fall next week. It may be getting far enough back. You're going back to February 7th that it may not, we need 7 more transactions to fail. The bulk of the transactions are starting to be closed. So once the transaction is closed, it can't fail. The bottom line is we're tied for the worst case in the past 25 years. We're probably going to become close to tied here. And here we may be second worst. Here will be the second worst because I don't think we're going to lose 150 transactions. And on these bottom 2, we're most likely going to be, this one, we will most likely be the second worst because I don't think we're going to lose 200 transactions. That would be 200, that would be 10%. We have been discussing the Silicon Valley real estate market. We will be discussing the real estate market in the Greater Bay Area, 13 counties based on 5 regions. I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers or sellers and single agency brokerage. Happy to discuss your needs with you. Appreciate a like and a subscription to the channel. The blue YouTube URL is the link to the archive channel of all the past episodes. You can type in the shorter green root URL, that takes you there as well. If you type in the shorter green root URL in the year 2025, it takes you to the live presentation Saturday morning at 9 a.m. Here's the passcode, the meeting code if you need it. Handout is posted. It's the green root URL, H for handout, the year, month, date code, so it'd be 2025-0315. And any specific episode, if you want to get there, you can either go to the YouTube channel or you can type in the green root URL, the year, month, and date of the episode you want. So, for example, if you wanted to listen to 2 weeks back, you would type in the green root URL 2025-0301 for the 1st of March. Again, I'm Richard Calhoun, real estate broker with Creekside Realty. Let's move on to the Greater Bay Area. These are the 5 regions that we're going to be breaking down into. Silicon Valley, the first one, cities, the second, North Bay, the third, Central Valley, the fourth, and the 5th is the Central Coast. Here's the data. This is active inventory. Active inventory is increasing in 4 of the 5 regions. I would call it flat in the Central Coast, which is a fairly small area, and it does behave differently than most of the other areas just because of the nature of Monterey and Santa Cruz. Here are the number of offers. Offers are increasing across all 5 regions, up significantly, steepness of the curve and all. Here's the days on sold inventory, the turnover rate. It's down in 4 of the regions. It's leveled off in Silicon Valley. Silicon Valley is the first one to level off, and it actually went up this past week. Who knows what next week will be, but because of the fundamentals that I discussed earlier, I would expect it to also increase. Here's your marketing time. It's down in 4 of the 5 regions. Again, Silicon Valley is the turnaround point. It's actually up and flat. It's going to be a step function. You can see when you're at the low levels, you get the step function like this, which is one of the reasons I had considered increasing the percentage from 75% to something like 85%. But then I'm currently deciding to keep it at 75th percentile because the third quadrant's a lot more standard than 85% of something. But again, Silicon Valley is the first to turn around. And what's significant about that is Silicon Valley often leads the marketplace. Now, that isn't always true. We had one of our slowdowns. It might have been the 2007 mortgage meltdown that may have started out in Sacramento. One of them started out in Sacramento. It was the wave went out, hit the wall, and then came back in from the Central Valley. Here's your ask price reductions. A little bit more mixed bag. You clearly had the least price reductions in the cities several weeks ago, increasing price reductions in Silicon Valley. But the other regions are pretty much still decreasing price reductions. So a little bit more of a mixed bag. Here's the frequency of those price reductions. You can see that we've started to increase in Silicon Valley, clearly increase in the cities, and still going down in the other 3 regions. This is the amount of overbidding. So this lags behind. Overbidding looks like it at least leveled off in the cities, appears to be rounding the top in Silicon Valley, is clearly going up in the North Bay, up in the Central Valley, but clearly going down in the Central Coast. So the Central Coast has less overbidding now, and right now they're actually reducing the seller's ask price by almost 2.25%, not quite, but close to 2.25% when they bring in their offer. Central Valley is down about 1/4%. And then everybody else is up, with North Bay being up about 1%, Silicon Valley being up 9%, and cities being up 9.5%. So if you get 9.5% more than your ask price, that's pretty good. So this is the frequency of overbidding. Again, a little bit of a mixed bag. It looks like it's rolled over in the cities. It's going up in all the other regions. Central Coast is a little bit more bouncy, but it's also a smaller region, so there's less transactions, which gives you more bounce. The larger the database, the more stable it tends to be. Here's long-term appreciation. Clearly, again, I think every week I point out the cities has done the least well, with only 6% appreciation since the last 9 months of 2015. Silicon Valley up here in the purple has done the best with just under 200%, call it 195% appreciation. Central Valley is close behind at about 90%. Then you have the North Bay at basically 60%. And then from second to last place, Central Coast, Monterey, and Santa Cruz counties. And that's down at around 55% appreciation. Pretty good considering the short duration. We're talking less than 10 years. And we're talking about appreciation anywhere from 45% up to 95%. Here's the sold price for the different areas. Sold price is going up in both cities and Silicon Valley, clearly on a downward trajectory in Santa Cruz, basically flat in Central Valley, and up very slightly in the North Bay. Here's the estimated payments, going to be in the same order and follow the same track record, more or less. Interest rates really haven't been impacting the payments that much, so it's basically the same as the payments. You can see that payments now are the sort of record level payments that we've had in Silicon Valley and the cities. In the Central Coast, you're down quite a bit. The North Bay, you're sort of reasonable, but you're not at the peak. And the Central Valley is the most affordable and basically pretty close to the peak. The actual peak was late in 2023, and you're down a little bit from that, but you're basically at the same level you were for most of 2024. Here's the numbers. The numbers are in the now column. The percent improvement from a week ago and the percent improvement or decrease from 5 weeks ago is listed there for each one of the different metrics. I don't do that for appreciation because in general it's up there, but you can see the numbers. And you can see you have quite a range. You have a high of 116% appreciation. And that is 116% appreciation because the number posted here is 216. So the price is double plus 16%. So 116% appreciation to a low of 31% appreciation in San Francisco. So quite a range in price appreciation. And these again are the chapters that are linked in the YouTube description, so you can jump to the chapter you find most interesting. I'm not seeing any unmuted mics, so thanks for joining. Take care. Have a great week. Bye now.